The world of investing in 2026 is no longer about chasing the latest viral trend or hoping for a lucky break with a single stock. With global markets becoming more interconnected and technology, like artificial intelligence, shifting the economic landscape, the strategy for building wealth has evolved into a more systematic and disciplined approach. Whether you are just starting with your first dollar or you are looking to optimize a six-figure portfolio, the key to success this year lies in building a defensible ecosystem that thrives on automation and strategic asset allocation rather than emotional reactions to the news cycle. Today, we are going to break down the exact roadmap you need to follow to secure your financial future, moving from the essential safety nets to advanced wealth-building vehicles that are designed to print money while you sleep. By the end of this video, you will have a clear, actionable plan to navigate high-interest environments, leverage tax-advantaged accounts, and select the right diversified funds that will do the heavy lifting for you over the next decade and beyond. Part 1. Building the Unbreakable Financial Foundation. To truly master your money in 2026, you must begin by constructing a financial safety net that can withstand any economic storm or unexpected life event. This foundation starts with the establishment of a high-yield emergency fund, which is far more than just a savings account because it acts as your personal insurance policy against high-interest debt. In the current economic climate, you should aim to set aside at least 6 months of essential living expenses in a liquid account that offers a competitive interest rate above the rate of inflation. By having this cash buffer readily available, you ensure that when an emergency like a medical bill or a sudden job loss occurs, you are not forced to liquidate your long-term investments at a loss or rely on credit cards that will charge you exorbitant interest and derail your progress for years. The second pillar of an unbreakable foundation is the aggressive elimination of high-interest consumer debt, particularly from credit cards or predatory loans that typically carry rates well above 15%. There is no investment in the world that can consistently and safely outperform the guaranteed return you get from paying off a debt with a 20% interest rate, so this must be your absolute priority before moving into more speculative assets. You should analyze every dollar leaving your account and utilize strategies like the debt avalanche method, where you target the debt with the highest interest rate first, while maintaining minimum payments on others to minimize the total amount of interest paid over time. Once these toxic liabilities are gone, you will find that your monthly cash flow increases significantly, allowing you to redirect those former interest payments into wealth-building assets that actually work for you. Finally, an unbreakable foundation requires you to have a crystal-clear understanding of your net cash flow through a rigorous but simple automated tracking system. It is impossible to build a massive investment portfolio if you do not know where your capital is leaking, so you must implement a system that categorizes your spending and ensures you are living below your means. This does not mean you have to live a life of extreme frugality, but it does mean that you must prioritize paying yourself first by automating a fixed percentage of your income toward your investment accounts the moment your paycheck hits. When you treat your savings and investments as a non-negotiable monthly bill rather than an afterthought, you create a psychological and financial environment where wealth accumulation becomes an inevitable byproduct of your daily habits rather than a result of luck. Part 2. Navigating the 2026 stock market landscape. Navigating the stock market in 2026 requires a sophisticated understanding of how artificial intelligence and domestic manufacturing shifts have redefined traditional valuation metrics. We are currently seeing a transition where corporate earnings are no longer driven solely by low interest rates, but by massive productivity gains found in automated supply chains and proprietary technology integration. For an investor to succeed today, you must look beyond simple price-to-earnings ratios and instead evaluate companies based on their capital expenditure into high-efficiency infrastructure and their ability to maintain pricing power in a fluctuating global economy. This means focusing on sectors that provide the backbone for this new era, such as advanced semiconductor manufacturing, energy grid modernization, and specialized healthcare tech, rather than just chasing the hyped names that dominated the previous decade. A critical component of your 2026 strategy must be the recognition of a more fragmented global trade environment, which has made domestic stability a premium asset. You should pay close attention to the reshoring trend, where companies are bringing production back to North America to avoid geopolitical disruptions, and how this impacts the profitability of mid-cap industrial firms. While large-cap tech often captures the headlines, the real value for a disciplined investor often lies in these essential service providers and manufacturers that have become the new defensive plays of the current market. By diversifying your holdings to include these robust domestic players, you create a portfolio that is less sensitive to international conflicts and more aligned with the long-term structural growth of the local economy, which provides a much-needed layer of security during periods of high volatility. Furthermore, you must adapt your tactical approach to account for the increased presence of algorithmic trading and the speed at which market sentiment now shifts. In 2026, price movements happen faster than ever before because data is processed instantly across the globe, which can lead to rapid corrections and sudden rallies that leave emotional investors behind. To take effective action, you should focus on identifying high-quality companies that are temporarily undervalued during these technical swings, rather than trying to time the absolute bottom of a trend. Successful investing right now is about having the conviction to hold through the noise and maintaining a watch list of assets that meet your fundamental criteria, so that when the market offers a discount, due to short-term panic, you are prepared to deploy your capital into businesses that have a clear path to dominance over the next 5 to 10 years. Part 3. Maximizing tax-advantaged accounts for accelerated growth. To achieve true financial independence in the current economy, you must understand that it is not just about how much your investments grow, but how much of that growth you actually get to keep after Uncle Sam takes his cut. Maximizing tax-advantaged accounts like the Roth IRA and the 401k is the closest thing to a legal cheat code in the world of finance, because these vehicles allow your wealth to compound without the constant drag of annual capital gains or dividend taxes. For 2026, you should prioritize filling these buckets systematically by understanding the specific contribution limits and income thresholds that apply to your situation. By contributing post-tax dollars to a Roth account, you are essentially locking in your current tax rate in exchange for a future where every single dollar of profit can be withdrawn completely tax-free during retirement, which provides an incredible level of flexibility and security when tax laws inevitably change in the future. Beyond the standard individual accounts, you must also look at employer-sponsored plans as a primary engine for your wealth, because the immediate return on an employer match is effectively a 100% gain on your money before the market even moves. If your company offers a 401k or a 403b, you should contribute at least enough to capture the full match, and then evaluate whether the traditional or Roth option within that plan serves your long-term tax strategy better. For those in higher tax brackets today, the traditional 401k allows you to lower your taxable income in the present year, which provides more immediate capital to reinvest elsewhere, while those who expect to be in a higher bracket later should lean toward the Roth side. The key is to treat these accounts as the core of your portfolio and automate the contributions so that you are consistently buying into the market with tax efficiency at the forefront of every dollar deployed. Advanced investors should also pay close attention to the health savings account, which often goes overlooked as one of the most powerful investment vehicles available today due to its triple tax advantage. When you use an HSA correctly, you receive a tax deduction on your contributions. The money grows tax-free while invested in the market, and you can withdraw the funds tax-free for qualified medical expenses at any time, or even use it as a supplemental retirement account after age 65. If you have the cash flow to pay for current medical expenses out of pocket, while letting your HSA balance sit in low-cost index funds, you are effectively creating a secondary tax-free pension fund that can cover your largest costs in later life. Integrating these diverse tax-sheltered accounts into a unified strategy ensures that you are building a massive surplus of wealth that is protected from the erosion of future tax hikes and administrative fees. Part for the power of automated dollar cost averaging. Automated dollar cost averaging is the most effective psychological and financial tool for building long-term wealth because it completely removes human emotion and the temptation to time the market from your investment equation. In 2026, the speed of information can cause massive daily fluctuations that often lead investors to buy at the peak of excitement or sell at the bottom of a panic, but a consistent automated strategy forces you to do the exact opposite. By setting up a recurring transfer from your bank account to your brokerage to buy a set dollar amount of an asset every week or month, you naturally buy more shares when prices are low and fewer shares when prices are high. This process lowers your average cost per share over time and ensures that you are constantly building your position regardless of what the headlines are saying or how volatile the current economic climate feels. For beginners and intermediate investors, the true magic of this strategy lies in its ability to turn market volatility into a strategic advantage rather than a source of stress. When the stock market drops, most people feel a sense of loss and fear, but as a practitioner of dollar cost averaging, you can view those dips as a clearance sale where your fixed investment amount is simply acquiring a larger stake in high-quality companies or index funds. This systematic accumulation creates a powerful compounding effect because you are never waiting on the sidelines for the perfect moment that may never come. Instead, you are keeping your capital productive at all times and benefiting from the mathematical reality that markets historically spend more time moving upward than downward. So, simply being in the game consistently is more important than trying to outsmart the millions of other participants. To take immediate action, you should integrate this automation directly into your payroll or your primary investment platform to ensure the money is moved before you even have a chance to spend it on lifestyle inflation. Advanced investors often use this as a base layer for their portfolio while keeping a separate cash reserve for opportunistic buys, but the core of their wealth is almost always built through this unrelenting consistency. By automating the process, you eliminate the decision fatigue that comes with managing a portfolio, and you protect yourself from the ego-driven mistakes that ruin even the most sophisticated traders. In the long run, the person who automates a modest $500 a month into a diversified fund will almost always outperform the person who tries to guess the market cycles with $50,000 because the automated approach guarantees participation in every single growth phase the market offers. Part 5: Advanced Diversification and Rebalancing Strategies. Advanced diversification in 2026 goes far beyond the basic split between domestic stocks and bonds, and instead requires a multi-dimensional approach that accounts for asset correlation and global economic shifts. To truly protect and grow a sophisticated portfolio, you must integrate non-correlated assets such as international emerging markets that are benefiting from new trade corridors and alternative investments like real estate investment trusts or commodities that act as a hedge against currency devaluation. The goal is to ensure that when one sector of your portfolio faces a downturn, another is positioned to capitalize on different market conditions, thereby reducing your overall portfolio volatility without sacrificing long-term returns. You should analyze your holdings to ensure you are not accidentally overconcentrated in a single factor, such as large cap growth, and seek out sectors that offer structural alpha, such as specialized infrastructure or companies with high intellectual property moats. Once you have established this diversified framework, you must implement a disciplined rebalancing strategy to maintain your target risk profile as different assets grow at different speeds. In a high-momentum market, it is very easy for a winning position to grow from 10% of your portfolio to 20%, which significantly increases your exposure to a potential correction in that specific area. You can choose between a calendar-based rebalancing, where you adjust your holdings every 6 months, or a threshold-based approach, where you trigger a trade whenever an asset class drifts more than 5% from its original target. By selling a portion of your winners to buy more of your underperforming assets, you are effectively forcing yourself to sell high and buy low, which is the fundamental essence of successful investing and ensures that your portfolio remains aligned with your long-term financial objectives rather than being dictated by short-term market swings. To take this to the highest level, you should also consider tax loss harvesting as part of your rebalancing process to optimize your net performance after taxes. This involves strategically selling assets that are currently at a loss to offset capital gains in other areas of your portfolio, which can save you thousands of dollars in tax liabilities over several years. This capital can then be immediately reinvested into similar but not identical assets to maintain your market exposure while keeping your tax bill as low as possible. By combining broad diversification across multiple asset classes with a systematic rebalancing and tax optimization plan, you create a robust wealth engine that captures the growth of the global economy while insulating your capital from the catastrophic drawdowns that often wipe out less prepared investors. This level of management turns a simple collection of stocks into a professional-grade investment portfolio designed for generational wealth. Building wealth in 2026 is a marathon that requires a blend of modern strategy and timeless discipline to reach the finish line of financial independence. By establishing an unbreakable foundation, navigating the technological shifts of the stock market, and maximizing every tax advantage available, you are positioning yourself far ahead of the average investor who is simply reacting to the noise. Remember that the power of consistency through automated contributions and the resilience of a well-diversified portfolio are your greatest allies in an ever-changing economic landscape. If you found this roadmap valuable and you want to continue mastering your money with high-level insights, make sure to subscribe to Sam Invests and hit the notification bell so you never miss a deep dive into the strategies that actually move the needle. We would love to hear from you in the comments below, so please leave a message with the phrase, "I am building my empire," to let us know you are committed to your long-term financial success, and tell us which of these 5 steps you are going to implement first in your own journey.